Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of LME 3-month lead and tin. I'll start with LME 3-month lead. Okay, it's still of great comfort here, even after the falls and rises we've seen in recent months. This market still keeps within the broken May to October 2020 bullish shift pitchfork, originally drawn, well, now a year ago. To recap the recent actions, prices had since this past August moved down from the upper time, currently 24.71, through the middle time, currently 23.01, all the way down to the lower time, currently 21.31, where they were halted to a great degree by the combination of the slowly rising long moving average, currently 21.88, and the big 50% Fibonacci lines of the March to August move at 21.60 and the February 2018 to March 2020 move at 21.28. The market then consolidated and in early October started to rise again, back up through all those previously mentioned supports that were now resistances, and peaked out 2 weeks ago at the upper time. We've since seen the market dip down to the big old 50% Fibonacci line of the 2010-2011 move at 23.78, where it found some support, if transitory, before last week and this dropping down to the congestion from July 2018 in the 23.31 area, where it has so far held. This is a somewhat surprising support area, but I take it for what it is. This earlier big move down though and then up from August has fulfilled a new pattern that had only become clear as the market started to move higher. It is called a diving board pattern, with the action from early August to mid-September being the diving board, the drop from mid-September to the low of late September being the dive off of the board, and the move back up from early October to date being the swim to the shore. It is not a common pattern, but it is one that is valid and perhaps more importantly incorporates other patterns such as triangles and halfway hesitations within it. Looking at this diving board pattern and making appropriate measures, I've detailed some 3 weeks ago. The initial topside target X for the pattern would be in the 24.11 area, with a possible secondary topside target in the 24.63 area. As you can see, target X was achieved 3 weeks ago, and if it wasn't for having the upper time in the way, I'm fairly certain we would have also achieved target X1 on top of that as well. However, so far it seems I may have to postpone target X1 for now. You see, it all now depends on whether the action from the start of October to date is either a topping action, the pattern of which is yet to be determined, or it is a possible bullish halfway hesitation, maybe even a bull flag. That is why the next few weeks will be interesting, as we will eventually see the construction of whether this is a top or a continuation pattern. It's only this week that we've seen the possibility of this being a bullish continuation pattern, such as a flag or halfway hesitation. However, it is still way too early as yet, and I would like to give the market some more time to determine its intent. LME 3-month tin. I've been repeating this here again and again for months and months now. The overall bullish incentive is still alive and strong here. This was and is because the original move up, which started back in March and then translated to a higher level in April, was due to prices moving up over the middle time, currently at 36.865, of the January to March bullish shift pitchfork. Prices even managed to reach up and over the upper time above, currently at 39.250 back in July and August, and even as recently as 3 weeks ago. Yet in all that time, prices have always come back within the folds of this bullish pitchfork, as it has done most recently as well. In all this time, this bullish pitchfork had and has driven prices higher. Now, admittedly, I, and I'm sure you as well, believe that no market can head in one direction all of the time. Thus, we saw major corrections back down in August and again in late September and another 2 weeks ago as well. It is important to note that despite these corrections, the market in all its pullbacks down has not managed at all to break the same bullish incentive. The evidence for this can be seen by how this market is still today well within the bullish shift pitchfork between the middle time, currently 36.865 below, and the upper time above, currently 39,250. Another point to note, and this may become more important if the lower time, currently 34,485, is challenged, is that the lower time has been married to its long-term partner, the rising medium moving average, currently 34,405, since at least August. It may be that if we see a separation of these two, then perhaps we may start looking at the bullish incentive and questioning it as maybe finishing. This is no more than a conjecture on my part at this time, but it does have a certain symmetry to it, so I suggest special attention to those two. This brings me once again to my final point, the same final point which I have repeated from previous commentaries. It is this, and I quote, "It can be hellish to rely on only one pattern because it can be hellish when it breaks." End of quote. So that is where we are now, once again. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final part.